G'day everyone, welcome back to another episode of Spark Your Fire. We're back on another property segment show here. I'm your host, David Shee, and today we've got another exciting market update for Melbourne. We haven't had our lovely guests. If you've been tuning in, you would have known Andrew Nguyen from Aurora Estate Agents. He's been with us for quite a while now, basically, being giving us very, very precious and valuable on-the-ground updates in terms of what's been happening in Melbourne. And I thought since last time, I reckon it's been over a year, actually.
I think it's before COVID, mate, to be honest with you.
Yeah. So
it's more than a year now.
It feels like forever. I mean, that's just the thing, right? Like when you have COVID, time just flies by. So yeah. So unfortunately,
so it's true what they say about long COVID, huh?
It is indeed, mate. It is indeed. Welcome back to the show, mate.
Thank you. Pleasure to be back.
How are you doing? Are you good at the moment?
Yeah, good, mate. Good. I mean, we obviously went through COVID. That was a bit of up and down. And then we went through this amazing market that no one predicted. Actually, the opposite of what everyone predicted for the last sort of 12 months. And now it's just coming down that roller coaster again. So, yeah, peaks and troughs. And Melbourne's still doing pretty well.
Did the COVID lockdown, which I know you guys had a long duration of lockdown, had it impacted on the actual property prices? Actually gone up or gone down?
Look, during COVID, it probably went down a little bit. And then everyone started getting used to the virtual auctions and the virtual inspections. And then we sold a few properties sight unseen, which I wouldn't do personally, but there were buyers out there who were willing to buy a property sight unseen, which was great for the industry. And then as we came out of that final lockdown, the lockdown was meant to last 2 weeks, which actually lasted 3 months. We came out of that lockdown and the markets went boom. Like it was absolutely bananas. Like, I remember we had a vendor who was pretty keen to sell because she was moving to Queensland, which is what most of our vendors decided to do during COVID, move to Queensland. I remember it was the 2nd of January after the New Year day. We had, I think, 110 buyers at that property, 20 offers, and sold at $60,000 over the range. And we're like, what the hell is happening? And that was just the trend that was going on all through that year. So it just came out of nowhere, mate, to be honest with you. I think people just saved a lot of money during COVID and then decided they wanted to buy a house.
Got nowhere else to live, got a cramped house. They go, where else can I spend my money? I want bigger spaces now. I've got kids that's running around. I can't work in the same room, so I need bigger rooms, right? So you're seeing a trend that basically even now people are still seeking for bigger houses, upgrading, basically.
Yeah, well, working from home is obviously a big option now. And I guess where we work in sort of out of southeast Melbourne, where you can buy a bigger home for not as, for the same price as a smaller home sort of in and towards the city, that demand for that sort of 4-bedroom, 2-bedroom, 3 living area home with a rumpus, with a big backyard, it's still a great demand. And I think that's part of the reason why prices around this area anyway have shot up quite significantly.
Have you noticed any changes in terms of that trend in the last 3 months ever since RBA has announced the interest rate increases, their cash rate increases?
Well, definitely after the first interest rate rise, I think it was 25 basis points.
25 basis points, yeah.
We definitely noticed a small shift. And then subsequently with that 50% basis point rise, that was a bigger shift. So if you ask me, are there fewer buyers in the market? The answer is yes. Subsequently, it means we're getting less offers. But I think the prices are still reasonably the same. Like we're finding the good properties, or the ones that don't need too much repair. They've got good friendly floor plans. They've got a sizable block of land. What I mean by that is 500 to 700 square meters with a backyard. They're still selling. They might not sell within the first week, but they're selling within 2 to 3 weeks. So I'm not that concerned with the market at the moment. I think, if people have a good agent, have a good marketing, and importantly, they've got their properties presented really, really well, I don't think right now there's any cause for concern. But that might change in 2, 3 months, in 4 months. I think the market, yes, sure, we've got a changing landscape and it's pretty fickle. So, that crash that people are predicting may come sooner rather than later, but I'm not that concerned. I don't see it yet.
So at the moment, what you're saying is the days on market has increased. In other words, it's taking longer to sell. The offers are a lot more conservative. In other words, people just don't go, I see it the first weekend, I want to put an offer straight away. They would now kind of go, let me go away and do my due diligence, which is in line with what they're saying. The sentiment has changed from fear of missing out to fear of overpaying to a degree, isn't it? In that sense.
Yeah, that's exactly it. But look, David, again, it doesn't mean that you can't get a good price in this market.
Yeah.
Like, yeah, absolutely, you're right. That the urgency in the market's completely changed, right? So we had a property on the market over the last 3 weeks, which just sold on Tuesday, and usually, that type of property would sell in the first week. You'd probably get 6-7 offers, maybe 30 inspections, and it'd sell, right? But of those inspections, we got 10. And 3 were interested, and they were genuine interest, but they took their time. They're like, we need to talk to our broker, we need to talk to our conveyancer. So you had to work within their parameters as opposed to the agent being in full control of the process. And that's completely fine. I mean, you got to adapt, right? And we still got over the line at very close to the high end of the range. So it's just taking a little bit more work now. And I think from a real estate perspective, from the industry perspective, I think it'll just flush out the good agents or the bad agents who, who just think that's a lot on Monday. And they did. But now it does take a little bit of work as well. So engaging the right agent during the sales process, during this market, I think is more crucial than ever.
Oh, absolutely. I think, we've... I know. I was going to say, that was a very smooth, Andrew. I'll let you off that one. But yeah, that is indeed. I think as the changing tides, I guess we've gone from a very booming property market to back to a normal market. This is where typically the good agents survive, and then a lot of the newest agencies started to die down. Same thing with brokers as well, right? Like we expected, there was a whole heap of brokers just came out from nowhere for the last couple of years, and then as things die down, and unfortunately, if they can't get business, then they have to look at shutting down. So that's just normal part of the cycle. But that's very interesting. But price-wise, because I know you're around Berwick area, and there's a lot of owner-occupied demands in your area, so it's not mostly investor type of people looking in the area. It's mostly owner-occupied. So it sounds like the owner-occupied market side of things is still holding up quite well. We're not looking at like a 5 to 10% type of discounts in terms of prices at the moment, even though the speed of the offer is slowing down, but it's still achieving not too far from the peak prices or, the high end of prices, is what you're saying. Correct.
Absolutely correct. And look, there still are a lot of investors in this market. And I remember like pre-COVID, right? There were literally, I think if you go back to our previous podcast, there was literally no investors in the market. And we spoke about the reasons why for that. But since during COVID, I think during COVID, investors started coming back. And now we are seeing a lot more investors in the market. Okay. So it's quite buoyant. I mean, and I think the reason for that is rents are pretty good. Like yields are pretty good. And time on market for rent is non-existent, almost non-existent. We had 4 properties for rent last week, and they're all gone. As of yesterday, which was Wednesday, they're all gone. So that just speaks to the nature of the rental market at the moment. It is absolutely chaotic out there. If the sales market is showing signs of weakness, there's no signs of that in the rental market at all. So investors are having a field day. We're doing about 5 to 6 rent increases a week now for all our properties. We just did one that increased rent by $70 a week.
$70, wow.
That's market value. That's not the owner saying I need to pay for my interest or whatever. That's market value.
Yeah.
So that's insane, right? For $400 a week property to go to $470, you work the maths. That's insane. Yeah.
It's crazy. Basically, I feel it doing it tough for those tenants at the moment who's $70 a week increase is not a small amount of money, I got to say, right? I think we're just so used to, you guys are probably used to like $10, $20 increase. That's kind of like the norm, but $70, like how, do you get much pushbacks from the tenants to kind of go, or do they kind of understand, okay, well, if they have a jump on realestate.com.au, you have a look at what's available, they'll probably see, okay, well, that's the market type of rent that you're getting, isn't it?
Yeah, you're always going to get with human nature, you're always going to get throwback with any expenditure that's put on you, right? But if you decide to leave the property, and that's what you say, you go on realestate.com and you want to stay in the same area, you're paying the same anyway. So it's just the nature of the beast in the rental market at the moment. It is cruel, I admit that, but our job is to act on behalf of our rental providers, as they call them here in Victoria now, and that $70 is not due to greed or due to any pressures on the rental provider himself. It's just due to the market.
Just the market, okay, fair enough. What about so when you say the gross rental return has gone up, what are you looking at the moment? Like let's say, I don't know, what's the average price of a Berwick 3-bedroom Berwick house that's kind of
Yeah.
selling? Is about 900K at the moment?
Yeah, so we just sold a 3-bedder in Berwick for 850.
850?
And the rent they're getting on that is 500. So
500, okay.
I don't know, your math is better than mine probably. But we can quickly work it out, right? So
Yeah.
500 times 52 divided by 500 times 52 divided by 850. It's 3%.
And that's a standalone house. Yeah, yeah. For Melbourne. Yeah, for Melbourne, I think that's pretty impressive because I think Melbourne, for some bizarre reason, Melbourne's rent just always seem to be, comparatively low when you talk about it. But for Berwick standard, that's quite good. What about the vacancy rate over there around Berwick? Do you know roughly the figures?
Always non-existent, mate. Things that are going on the market are filling up.
Yeah.
Like if we've got properties where we don't even have to go to market. We've already got a renter that's waiting to go in there.
Wow.
We've got a long line of applicants who are solid applicants.
Yeah.
Like we met a renter today in Donnybrook, which is in the north of Melbourne. They had been able to find a property for 5 months, and their application is solid. Like serviceability, good rental history. It's solid. There's nothing wrong with it. It just so happens that they've met other renters or come across other renters that just have better serviceability than them and a better rental history. So it's a tough market, and we've got a lot of people waiting to get in, and we're finding that people are staying with their parents, like in a 1-bedroom with 2 kids, staying with their parents. So it's really tough rental market out there at the moment.
That's why most of them will still consider buying instead of renting, because it's actually probably going to be easier to buy than rent in the current market, isn't it? Given the fact that there's less buyer demand in comparison to a total brutal rental market that you're going to have to try to find in like a dog's breakfast.
Yeah, correct. And I was reading, I just saying before, reading an article that some rental markets are more expensive than the mortgage itself. So if someone's got the ability to afford a deposit, even if it's 5%, I know there's some schemes out there at a state and federal level now that allow you to buy a home with a 5% deposit. I think it's worth looking into, most definitely.
Yeah. That's right. The deposit, and also I think actually, funny enough, I know this week New South Wales has announced that we're doing a stamp duty reform, and for first home buyers, that is. And they're looking at scraping that and change that to annual land tax. Do you reckon that could potentially come into Victoria if that proves to be successful, or has there been talks from Victoria perspective to scrap stamp duty as well?
Yeah, I've heard some mumblings about it, but I don't know how in-depth the discussion has been.
Yeah.
I mean, I thought I'd seek your thoughts on that, David. Turn the table a little bit, because I'd like to know what you feel the impact of that change is. I mean, obviously there's no upfront payment for stamp duty, but to be spread across the long term, my views is I thought that would be more beneficial to the government over the long term, because it's giving them more cash flow.
Steady revenue, correct. Yeah. Look, I think it's, stamp duty is probably one of the worst tax that people have to pay at the moment, right? But having said that, I think I saw an article this morning that Domain calculated works out to be, if you purchase a 1.5 mil property in Sydney, it will take you about 18 years to break even on the annual land tax versus the upfront stamp duty payment. So for some people, 18, So in other words, you pay 18 years of annual land tax in order to be equivalent to how much you pay upfront on the stamp duty.
Okay.
So that was an interesting thing that I read this morning. I thought, like for most people, that probably makes sense. But if you if you're intending to hold the property a longer term, like especially as a property investor, right? If you are intending to hold it 20 plus years, 30 plus years, because that's where the compound growth is going to kick in, then you're probably going to have to cop it a lot more in that sense. Personally, I mean, for me, I would still opt to choose to pay stamp duty upfront just because it's a once-off fee in that sense. Get it out of the way rather than having an annual land tax that I have to continuously pay as an ongoing stream of cash flow. But again, it depends on individuals, right? Like, if you're struggling to get that deposit, well, maybe this annual type of land tax is going to be more beneficial. And I think a lot of my clients, first-time buyers especially, is actually welcoming this type of idea. Interesting enough. So.
Do you think it's going to push prices up though? Like, I mean, every time the government, even in Victoria, announce some sort of affordability policy, it always seems to push prices up because buyers go, well, I don't have to expend that much now for stamp duty. I'll just put it towards the price of the home.
The price of the home,
to alleviate my competition, right? Do you think that's going to have that effect?
I reckon on the lower end side of things, probably it will. So in other words, I reckon the units are probably the most beneficiaries out of it because in Sydney, the units are around, you know, maybe the 500 to 800 or even 900 type of range, right? So people can afford to pay a bit more in that instance if they don't have to pay stamp duty. And therefore, that kind of price bracket is probably going to go up a bit more. Whereas the higher end of ranges, you know, because it was capped at 1.5 mil. If you purchase a property that's over 1.5, and a lot of houses in Sydney at the moment is over 1.5, right? You probably want to get an entry house at 1.5 nowadays in Sydney anyway. so that side of things, you know, people probably do the numbers and go, doesn't make much sense. I'm just going to pay stamp duty up front instead. So that's my view again, you know, but it'll be interesting to see, you know, if that proves to be successful as a scheme. And they're also saying that government could do more because at the moment it's only for first home buyers. If you're looking at upgrading, if you're looking at downsizing, doesn't apply. You still got to pay stamp duty. So, you know, a lot of them are saying there's probably 1/5 of the property in Australia that is fully unencumbered, so no mortgage. But at the same time, there's like those houses got like 2 or 3 spare bedrooms, which is not being utilized, right? You're looking at those Gen Xers or, you know, basically baby boomers who wants to downsize, but hey, if I downsize, I need to pay like 40, 50K off stamp duty. Doesn't make much sense to me. So therefore they do not want to downsize. So that's kind of like, you know, a problem in the longer run that if government introduces and works for all, including downsizers, I reckon that might create a bit of a shift and it will free up a lot more houses for people in general. That's my view. So
makes sense.
What about you? What do you think? If that gets applied to Victoria, let's just assume for a second, first home buyers, if it gets applied to Victoria, what do you reckon it's going to have an impact?
Yeah, definitely. I think prices will go up, particularly for the first home buyer market.
First home buyer,
I've not ever seen in my 10 years of experience in real estate a home affordability scheme make prices go down. So I always say it's probably not about home affordability; it's about home accessibility. It's just making it more accessible. That's all it is. Even if they decide to cut stamp duty altogether, which it will never happen because it's one of the greatest avenues for revenue, it will still increase prices. So I think we're just in a tough world at the moment where I don't think there is much room for policy change or movement that will decrease prices unless we overstimulate the supply side, which means we've got to fork out more for infrastructure, like down in Berwick, down sort of the newer end, Clyde North Officer. There's a good decent amount of supply, still not enough, but the infrastructure's not catching up. Like there's just massive traffic down here. So there's I think we're decades behind in terms of our suburban planning as well as infrastructure planning, and that's an issue for government, for state government in particular, to work out. And you know, if we leave this much longer, I think house prices are going to continue to increase, and supply is going to not keep with the times. And as a result, we're just going to be talking about the same issues of home affordability for I think years to come.
Especially with immigrants, right? Like they're starting to open the borders now. You know, they obviously want to, you know, immigrants bring in their families, want to look at desirable areas to live in. Berwick's obviously one of the options for them, even though it's pretty expensive to kind of rent there. But, you know, at least that's probably one of the main reasons why the rental is so tight at the moment as well, isn't it? Are you seeing a lot of immigrants making the rental applications side of things, or
not yet? Not yet. Yes, pre-COVID. Yes,
pre-COVID.
Yes. I sold a lot of properties to a lot of visa holders who could buy homes while they were working here.
Yes.
But no, that's sort of dropped off. So we're meeting probably a lot of people who lifestyle change, going from other suburbs to Berwick because they're getting a bigger home, a bigger land, working from home, downsizes, upsizes. Yeah, generally people who already have a residential place here and they're just moving from one place to another. It's just transitioning. Yeah. So no, I haven't. I don't recall selling any properties post-COVID to someone on a visa or renting someone out to an immigrant. No, you're right. It's changed.
I reckon. I
But
mean, it's just the start at the moment, right? There might be more coming, and we'll see how
yeah,
things go. At the end of the day, it's still a desirable place to live, especially
yeah,
from world's perspective. They look at how COVID is now under control in Australia, whereas in the Southeast Asia side of things, it's still kind of been very rampant around that area.
yeah.
So, I think in the long run, it will continue to attract good immigrants coming in.
Mm.
And Melbourne traditionally has been one of the main first stop in terms of immigrants coming in. Whether they move to Brisbane or not is going to be another question later on. But
Yeah,
that's definitely one of the areas, isn't
yeah,
it? So
most definitely.
with I know you specialize in Berwick. Do you know much about other areas of Melbourne in general, like how our prices are? Like, are there actually areas that actually softens a lot? Because I know Berwick has got a lot of own occupiers and desirable areas,
Mm.
so they probably haven't. Yeah, they what probably won't be one of the first areas that gets impacted as interest rate continues to climb. What
Yeah.
about other parts of Melbourne? If you do you know much about that?
So what I generally watch out for, David, to find out when Berwick's going to, finally be affected by a price rise or a price drop,
Mm.
is I always look at the inner city. So Melbourne has a particular trend, and it's probably the same in Sydney too, I'd say,
Hmm.
is when clearance rates start dropping in the inner city,
Yes.
it's probably a flow-on effect about 6 months before it starts to get to an area like Berwick.
Okay.
So in the last 12 months, I'd say, in the inner city areas at your Toorak and Norris's, around that area, clearance rates are about that sort of early to mid 80s%. It's very, very strong.
Mm.
In the last 4 weeks, I've noticed that they've gone to about the high 60s to the
High
low
60s.
70s.
Okay.
So it's still good. Like, I think anything in the 70s is still
Yeah.
reasonably strong, right? But when you start dropping into the high 50s, low 60s, that's when you start getting worried. So I would say whatever we're seeing now in the inner city, with that sort of high 60s, low 70s clearance rates, we're going to start to see in Berwick within the next 4 to 6 months.
Okay.
So we're definitely, yes, the market's definitely softening, and we definitely haven't reached the bottom of the trough yet. That's probably another 12 months away.
Okay.
And then, as it always happens in Melbourne, there's another boom. So,
Before you realise, right?
if you're a property investor here, you got nothing to worry about in Melbourne. Melbourne trending long term is always increasing.
Yeah.
There will be
Yeah.
peaks and troughs in any markets, whether that's shares, bonds, crypto, whatever, right? There's peaks and troughs, just some greater peaks and greater troughs. But I generally find Melbourne's a pretty safe area to invest in. And if you're planning to hold your investment for long term, you've got nothing to worry about.
Yeah.
I guess the markets that should really take advantage of what's happening now are first home buyers and people wanting to get into the investment market. Because, yeah, prices are softening, but rents are like A grade, right? So
Yeah.
if you've got some cash that you want to invest, or you feel like you've got some equity you want to take advantage of, then I think buying an investment property maybe now or maybe wait that 3 to 6 months. I think there's going to be some really good opportunities there compared to what you could have found 12 months ago.
Yeah. No, absolutely. I think if the rates do go up high, maybe another say 2%, 1%, 2%, there's going to be a lot of people, unfortunately, is going to be swimming naked, right? And that's when we all know who's going to have a problem in terms of affording them their mortgages, repayments. And I think at the moment it's actually wise to keep some cash available, because I reckon there'll be some really good deals that's coming.
Absolutely.
Yeah.
Absolutely. Yeah. And I'd be interested to see where rates go, actually, because I've been speaking to our mortgage brokers down here, and I'd like to see your thoughts on this too. But they're adamant that interest rates won't go above 4%. They're saying that if it does, then a lot of people will be swimming naked, and the whole housing market's just going to go AWOL, just crash. So, I mean, do you feel like it's going to go above 4? Because we're about that 2.5, 2.7 now with the bank rate. That's only a few interest rate rises.
Yeah. I mean, it's so the official cash rate at the moment is 0.85, right? We've had a 0.25 and we had a 0.5. And I think a lot of the owner-occupied mortgages are now trending towards 3%. I'm already seeing some at 3, probably mostly at high 2s. So it's actually not that far from 4%, I gotta say.
Yeah.
Okay.
Yeah.
Just another 1% increase is going to have that impact. But having said that, whether RBA, I think RBA is going to go in strong early, and they want to get that, they want to get inflation under control. That's the main thing.
Yeah.
Ultimately, I don't think they want to raise interest rate to kill the economy, because that's the last thing they want to do,
course,
is to put everyone into recession, right?
And then drop interest rates again.
Yeah, exactly. So there's actually a funny thing saying, I think was it one of the Westpac economists to say, in 2 years' time, they probably have to drop interest rates again to keep things going, to get the economy back alive, right? But how high would it go this time? I don't know. Depends on the whole Ukraine-Russia situation, because that's mainly the supply chain issue, which nobody knows. But the whole world is basically what we're doing is we're back to a normalization cycle. Like we're coming out from the emergency and we're back into more of a 1 to 2% type of cash rate ranges. And I keep telling my client, you need to get used to it. This is back to normal. This is the normal, right? What people have experienced and they thought the rates will never rise. That's not normal. That's the emergency setting. So that's why a lot of people are kind of like, oh, I'm so scared. If it goes up another 1 to 2%, how it's going to impact? Give them that confidence. Say, hey, when banks assess your finance, they actually use a 3% buffer in that sense. So they stress test you 3% on top of what you're currently paying in terms of your interest rates. Okay, so that's the buffer that they have put in to make sure that you don't go bankrupt. You don't need to force sell the home. And I think at the moment there's a lot of sentiment type of stress. But when people get used to it, when people work out, okay, well, I can actually afford it, and when that becomes a new norm, they'll get over it. And then the other good thing is I think wage growth is also kicking in as well. So, people are negotiating for better wages because, inflation and everything. So they need to. And and again, they just need to make sure that they do a household budget. Next 6 to 12 months is not going to be easy. Everyone will feel that pain. We all do, like every one of us who've got mortgages, we all do as rate keeps on going up. But having said that, in the long run, I think it will just be what they call, this will be like a blip. And then when people get used to it, they'll forget it, they'll get on with life, and they'll say, right, where can I invest next? Just back to normal.
That always seems to be the case, isn't it? And you're absolutely right. I mean, I think we've had the benefit of low interest rates for 10 years now, and getting out of it is a difficult predicament. But everyone would just readjust. Because I keep getting told when I do appraisals, for people who are in their 50s, 60s, 70s now, oh, Andrew, this is normal. When I was, blah, blah, we paying 19% interest rates. I'm like, I get told that story every time. So I think 3, 4, 5%, I think that's that's a sobering reminder that people were now, 20, 30, 40 years ago, were paying really high interest rates. So
and funny enough, at that point when interest rate goes up to 19%, that was also when inflation is out of control, right? So very similar to this time, except that time they weren't able to get it up to control, so they had to push that up so much. But imagine if it goes back up to even just 10% interest rate, like there'll be so many people will have to live on the streets, right? And that's going to cause a society issue. I don't think RBA's got a bunch of very intelligent people. They're gonna make it to that level. They're trying to seek a balance at the moment by pushing hard up early to try to get the inflation beast under control. But then after that's under control, we'll just leave it as is. So, and maybe dial down a little bit so the economy can get reactivated. People are having to spend again. Business will boom again. That's the kind of idea, basically. So,
well, that's a nice optimistic outlook anyway. That's good.
I think we always got to have optimistic outlook, mate. But it's awesome. Any other things to add, Andrew, in terms of the current Melbourne market or around Berwick, or what's your advice for investors at the moment? What do you reckon? Like, if people are looking around Berwick, what sort of property should they be looking in the current environment? Should they be investing in for longer term protection based on your personal experience?
Well, my personal experience, and look, agents who sell off the plan are going to hate me for this, but steer clear of apartments, particularly one-bedroom apartments. I remember pre-COVID, I helped sell this development in Brunswick, and they were like these tiny shoe boxes, right? But everyone was falling over them. It was my job to sell them, obviously. I just don't see the growth out of them. Even in a hot market, they just don't grow that much. So, as an investment, I think they're pretty poor investments. I think what that product is suitable for is someone who might be single, or maybe a young couple who work in the city, who need that accessibility to transport, don't really have a car, don't go anywhere outside the city to visit friends and family or for recreational purposes. I think it's a great product. But as an investment, they're really poor products. So if you're going to look at an apartment, I would say at least 2 bedrooms plus is something to look at. But anything less than that, I'd steer clear of. And outer suburbs, I think there's a great untapped potential in the west of Melbourne as well. I look at from the city to Berwick, you're looking about 55 kilometers. So it's on a good day, about 40 minutes to get in. Like, you draw that radius from the center of the Melbourne CBD to the west, there's literally nothing out there in terms of
Yeah.
houses, right? It's all getting developed. Like you think 10, 20, 30 years time, that area is going to be, it's going to boom. It's going to boom. Like, it just has to. It just has to mirror what's happening on the southeast. Yes, granted, the infrastructure in Melbourne's east is much better, but it will catch up. It'll catch up. Like property prices are quite cheap compared to what they are in the southeast. But if you're savvy enough to buy a good buy it, they get a new home, take advantage of the depreciation schedule. You know, the capital growth is going to be multiple timefold once you decide to sell when you retire, you know, whether that's a 10 or 15, 20 year investment, it's going to definitely pay off. I do think if you're buying in the southeastern suburbs, it's a lifestyle choice, really, because you want to be in the center of Melbourne where it's all happening. But if you're looking in terms of making money, like if you're an investor in Brisbane or Sydney or, you know, Perth, and you're looking to make an investment, you're going to do what's right for the dollars, right? And that's to look for the opportunities. Yeah. And there's not really that many cheap opportunities. Like we're looking at 3% yield, and we're like, yeah, that's pretty good. But you can go out to the Melbourne's West, and you get 4 or 5% yield, right? Yeah. Better yields. Yeah. Probably better capital growth over the long term as well, because they're starting from a lower point. I think there's massive opportunity out that way. But look, that's not going to stop people buying the southeast. The southeast is always going to be a popular spot to buy for investors and for home occupiers too. So that'd be my hot tip, long-term tip. Maybe review this podcast in 10 years.
Hey, in a few years' time, I'm sure we'll bring it on and we'll have to look at that. But yeah, look, I do agree with you. From numbers perspective, it makes sense. But I think, and this is one of the myths about Melbourne, right? Like if you guys have gone all the way out to the east side of it, extrapolated, like I think even up to 70 kilometers. But the west, like, you know, you still got a whole block of land that's kind of like, it's probably only go up to 20 kilometers or thereabouts. I think it is more like a demographic issue, because the west the west price will never match the east for certain reason. There's just, I don't know whether the Melbournians just prefer the east a lot more, and it's got established infrastructures, better demographics, that kind of stuff that's attracting. And they always thought that the western side of Melbourne is kind of like the lower social demographic, not as desirable, etc., etc. Like I reckon that's a myth to me, to be honest. Why would people always want to go, like, if you just buy even 70 kilometers out to the east, when you can probably get something more like a 20 or 25 kilometers to the west? From investment, that makes sense, but there must be something that I'm missing and I'm not joining the dots here.
No, I don't think you're missing anything, David. You're right. It's infrastructure. Okay. It's the fact that it's established. It's the fact that it's got history. Yeah, and it's what people know, right? It's just like in Brisbane. I lived there for quite a while. Is if you live on the south side of the river, you're going to stick on the south side of the river, right? If you live on the north side of the river, you're not going to consider buying a house on the south side of the river, even though they're like 20 minutes apart. It's just bizarre. It's just how people think. But the reason why Melbourne's West is like how it is just because it's just started later than the East.
Okay.
So you just have to extrapolate what happened in the East 20 years ago. That's what's happening in the West now. So yeah, if you're talking about lower socioeconomic, look, 20 years ago was Berwick where it is now. It's not.
Yeah.
Even 10 years ago, 7 years ago, when I was selling a property in Berwick, what I was selling for $850 now, I was selling for $450 then. So it's just because it's lacking time. That's all it is. So if people can people understand that obviously money takes time to build. There's no quick schemes. It's going to pay off in the long run. I don't think it's a prediction that I feel like I'll get wrong. I mean, a lot of other people say it as well, but it just keeps getting ignored because it doesn't have the infrastructure. Yes, granted, it doesn't have the history yet, and it just people don't know about it yet. But the investment's always too late when you're jumping on when everyone else is jumping on, right? Exactly. You jump on before everyone jumps on. Like look at Bitcoin, when people were jumping on when they were like $1, they're laughing. Yeah. Even if it's dropped now by 60% over the last 6 months. Yeah. They're still laughing. So if you can take advantage of all that and understand how the property market grows over time, in 10 years you'll be laughing.
Yeah, no, absolutely. I think that's really, really wise advice. And I'm sure I've looked at Melbourne West before previously, actually. And I remember I was looking at Sunshine, this is back in about 2017, Sunshine West, around that area. Houses were selling about $300-something thousand. It was like, I know, it was looking ridiculous. But because of the yield, I think I was still, because I was coming from Brisbane at that point in time. We used like 6%, 7% type of yield. I was like, 4% yield, are you kidding me? So I keep looking further away. That's why I hit Geelong, and I finally ended up buying in Geelong, and it was really good as well, by the way. So we'll leave that story to another time. No, thank you, Andrew. Look, that's really, really helpful and really wise advice as well. Thank you for your updates. I'm sure we'll bring you back in a couple of months' time just to keep track of what's really happening with the Melbourne heartbeats. And for everyone else, thank you for tuning in today. If you got any comments for us or Andrew, just feel free to comment below. Let us know. And if you like our contents, don't forget to like and subscribe. Otherwise, we will see you guys again in another episode of Spark Your Fire. Take care and bye.
Pleasure, David. Hopefully it's not in a couple of years.